Welcome, everybody, to another episode of Turing's Distinguished Speaker Series. The theme here is how to scale unicorns. Our goal is to focus on companies in that post-unicorn scaling stage, learn about things to do differently for companies in that stage, for founders, CEOs, board members, execs. And I like to invite CEOs of companies in that unicorn plus club, as well as investors backing some of these iconic companies, being on their boards and what they learned from CEOs and exec teams running these companies. Today, I have a super interesting guest. We have David Zhang from TCV, and I'm excited to welcome David to the show, and I think we'll have a fun, hopefully useful conversation over the next 45 minutes. Welcome, David.
Thanks for having me.
Great to have you, David. And before we get started, could you share a little bit about TCV and what got you into venture?
Yeah, sure. So, I'm a partner at TCV. We were founded in 1996. We're what we call a crossover fund. And so by that, in sort of broad strokes, what we do is we invest in technology companies. We've been doing this for almost 30 years. And we look at companies past what we call a product market fit stage. And so you think of the typical, two founders and a pitch book in a garage. Like, that's not what we do. That's the sort of pre-seed Series A types of investments where, companies or founders have visions of where they think their underserved needs in the market, and they're coming up with something super exciting to try to solve that. We come in after that. We come in after a product has landed, it has found product market fit, it has some kind of escape velocity, it's sticking, people love it, whether the end customer is a consumer or a enterprise or SMB. That's sort of where we come in. So we will invest in anything that's sort of Series B, the conventional Series Bs, all the way through public. And so that's sort of the super quick intro on who TCV is. And I think to your question, Jonathan, on how I got into venture, I broadly, I kind of stumbled upon it, if you will. I've been, in and around technology for over 10 years. Founded and ran my own startup more than 10 years ago, and that's sort of how I started getting a taste of it. Didn't really work out, and found ways to be around it, whether it was on the sell side. I was at Goldman for a few years, and then I also invested in tech companies as a public markets investor for a number of years before I landed at TCV.
Got it. That's great. And I didn't realize you were a founder of a company yourself.
I was, yeah. This was in circa 2009, and we were trying to, a couple of buddies of mine were trying to basically co-found the Zillow of Asia, if you will, and it was. I think there was a bunch of reasons why it didn't work out, but big part of it was timing, which I think is really important as well. The end market and sort of that intersection with technology just wasn't. I think we were a little bit ahead of our time, and so obviously there are a bunch of other reasons why it didn't work out. But yeah, that was a brief stint.
Got it. Yeah, timing is key. And speaking of timing, we are in a super interesting time right now. With is interesting the right word? I don't know what the right word is. With what's going on in the public markets and sort of the ripple effect in the private markets, what is your view on what's going on right now, and what does that translate into advice that you give to your startups? And I'm sure a lot of your startups are fairly large companies in that in that unicorn stage and beyond. What do you make of all of this, and what is your guidance to your companies?
Yeah, it's certainly a super interesting time. It's interesting for a bunch of reasons. I think everyone's sort of, the sky is falling, and in many cases a lot of people think it's doomsday. And the what's super interesting about it is the narrative has completely turned If you just, wind the clock back a year ago, it was the complete opposite, right? Things were never rosier. We were at the tip of a bull market. At that time, it was hard to tell because, this time is different. The train keeps going. Like nothing. The party wasn't going to stop, right? It was like there was no end in sight. And now it's like, gosh, the sky's falling, and it's the complete opposite narrative. There's a lot of fear in the market. I will say the broader issues are sort of like you kind of got to take two things and parse them out separately. One is the investor sentiment, which is what I just described. The other is, the reason why investor sentiment is changing is there appears to be potential fundamental cracks in the economy. It's not quite 08, 09 yet, in the sense that we haven't seen any systemic collapses or big pockets of the economy completely get decimated, but there's certainly worries about those things happening. And big part of that is trends and signals that portend a potential calamity, right? So inflation is always, it's always one where it's not fun. There can be all kinds of different knock-on effects from it. So that's the big one, obviously, with the geopolitical tensions, not just with Russia and Ukraine, but if you look at the governments, leaders of the world, the movements and leadership, and so on and so forth. There are a bunch of things that get people really unsettled, and unemployment, so on and so forth. So there's also that. I will say, and maybe I'm deliberately trying to be a little bit more optimistic. It's we're not there yet in the sense that there's a lot of worry, but it really doesn't feel like the economy has collapsed yet. So the kind of thing that I think most people are starting to, the founders that we certainly work with are starting to think about. The top of mind question is, hey, in that scenario, when the market does hit a downturn, or if it does, like a severe one, how long will it last for, and what happens in that scenario? There's a bunch of conventional wisdom out there, and so, hey, one of them that's super trendy, if you will, is, hey, make sure you have 3 years of cash runway, right? Sequoia sent out this deck, which I'm sure you guys have probably seen it too, and a lot of other investors these days. Anything that goes around just gets circulated like wildfire. It's almost like the venture community itself, it's almost like an influencer bubble.
Yeah.
But everyone sees the same decks, and they're like, oh my gosh, like you gotta have 3 years of cash runway. Make sure you're this and that. I think a lot of it is platitudes in my humble view. There's a danger in providing one size fits all type of advice. I think every company is super different, and certainly we take that view. We have obviously multiple companies on portfolio, a third of them which are public, and so they're all different sizes, different stages, different geographies, different cash positions, different market leadership positions. I will say the one thing that we tell all our portfolio companies, we say get fit and lean in. Get fit and lean in. And so get fit part of it is, whatever your circumstances today, turn inwards a little bit, do some introspection, and figure out which part of the house requires some cleaning up. If and good CEOs will look inside and say, hey, maybe we've been hiring a little bit too much during the the sugar rush phase of the pandemic, and what does that mean for performance management, right? Like, have we become soft? Can we squeeze out more from folks that we've hired? And are there things that maybe we have completely neglected, where we can now use the opportunity to right size it, or to make it better? And so, and then if you're a market leader, so, and that's the getting fit part. If you don't have enough cash, and I would almost say you should always have 3 years of cash runway. And so, like, this becoming now the number one piece of advice on the street is kind of silly, because that was always certainly supposed to be the case. And so if you don't have that, you better get it now.
Yeah.
That's for sure. But even other things, right? Like, hey, do your economics even work? I think fortunately for us, like, the companies we invest in, we care a lot about that in the first place. So there generally isn't that problem. But gosh, if your economics don't work, this is the time to make it work, right? Because survival is super important. And then the lean in part of the get fit and lean in is, hey, if you're a market leader, for example, your house is in order, things are going well. How do you use this opportunity to separate yourself from the pack? Right? Oftentimes chaos creates some of the best opportunities. And so, we tend to back, at least disproportionately, we tend to back leaders, category leaders. And so, as part of our DNA, it's, hey, if you are in that position and you feel like, okay, I'm in a decent spot now, um, this is the time, right? There are others that are going to be potentially suffering, or the others that are not as well positioned as you as a leader. How do you use this chance to kind of really break away?
Yeah, David, that was super insightful. I like the get fit and lean in, and of course, like 3 years of runway, you should always have it. Like this shouldn't be the trigger to for you to think about that. I feel the same way, and at least for me, like one thing that from Turing's standpoint, the way we think about it, and is we were in a blitzscaling phase where, in Reid Hoffman's terms, where you prioritize speed over efficiency in moments of uncertainty. And now I think there is there is a shift that we're seeing where everyone's prioritizing efficient growth, efficient scaling a lot more than before, which means things like contribution margin, things like burn multiples, things like GTM efficiency, the ROI of different marketing channels, magic number, things like that, like become payback periods, collections efficiency, things like that become more important.
Mhm.
Do you feel the same way? Like the focus on efficiency of growth is more important than just pure top line growth? Perhaps
Yes.
last year we were much more sort of in the high growth rate mode. Not we didn't care about how we got the revenue, but we got it. And now we are much more careful about revenue quality, revenue stability. Would you say that?
Yeah, I mean I love the candor there, Jonathan, and it's very true. I mean, I think you characterized it super well. I don't know. I know the Reed quote, but I'm gonna maybe botch it a little bit. I do think that that actually is, again, like, as you dig in, it's probably, at least from our view, speed and all that stuff for sure. I think that actually relates a lot more to product. The way I had seen that quote before, it's not necessarily business. So there's the product side of the house and there's business side of the house. Product innovation and velocity for sure, right? And that's the
Yeah.
beauty of software in general, because you have this concept of MVP, right? Which
Yeah.
is the beauty of software. Building a business around it, though, has always been, it's different, right? When you're building a business around something, you're monetizing something, you're going out to acquire customers, you are then creating something around it. We've always thought about that, and this is kind of one of the key pillars that we talk to about internally, but also to our founders, and all the companies that we invest in have a very similar value alignment, and we call this quality of growth. This has always been one of the number one focuses that we've had, whether it was 2022, 2021, or 2001. And by quality of growth, the centering question has always been, how do you grow as quickly as possible without sacrificing underlying unit economics?
Mhm.
That's it, right? And so having just growth, it's not enough. You need to have it as high quality as possible. So I'll give you an example. We led the investment in Nubank, their Series F in 2019. And obviously now they're a public company, and they're a great example of high quality of growth, right? Every customer that they onboard, for example, every single customer, they have 60 million now. Nubank has a view on the net present value of each customer. When they're
Mhm.
onboarding it, they have models to show it. They have quantifiable risk profiles, and
Mhm.
ultimately it maps to what they call lifetime value, right? And these things will change dynamically as they see real-time signals from how customers are behaving when they're paying back their bills, when they're loading up the phones, stuff like that. The vast majority of their customer acquisition is word of mouth. So they acquire customers with very little marketing spend.
Mhm.
You put those two things together. I'm being super, obviously it's I'm simplifying, but when you put those two things together, you get high quality customers, you get high LTV, and you get an acquisition at a super low cost, right? That's an example of great quality of growth, right? Not just blind growth. Let's go chase number of customers or revenues. And by the way, they are also growing at a crazy speed on all
Yeah.
those dimensions, but the quality that's underlying it, it's also really high.
Yeah. Yeah. That's great, David. And so you mentioned a few that was super interesting. Um, how do you measure quality of growth beyond? I mean, NPV is super interesting. I mean, you can kind of estimate the sort of the LTV of that customer, and of course, you're tracking your CAC. And in the new bank example, it's great that it's word of mouth. Do you have any other sort of efficiency metrics that you look at when you evaluate businesses to check the quality of growth, the quality and the quality of the revenues?
Yeah, I mean at the highest level, it's to, again, to be quite simplistic. It's interesting because if you use this concept, you can apply it to both consumer businesses as well as enterprise software businesses. You acquire customers, right? Customers come in, and they either leave or they stay. If they love something, they typically stay. And then there is a cost that goes out with that acquisition. So whether it's hiring a salesperson, commissions, or paying Google, or sometimes you don't pay them at all, and they come in word of mouth. Like, all these are different ways to acquire a customer, and those customers must bring some kind of value to you, right? So if you break it down to those components, there's really three components. The first is, how are you acquiring a customer? That's number one. And then the number two question is, are they staying? Right? Because if you're acquiring customers, but they're leaving at a super fast pace, whether they've tried it once and they leave because it's episodic in nature or all kinds of different reasons, then you have a leaky bucket, right? So is this a one-time acquisition, or is this a multiple time acquisition to get the person in the door?
Mm-hmm.
And then finally, it's doing the math on the value, right? So a cost, whether it's $3 or $3,000, can make sense depending on what that person eventually pays you back.
Mm-hmm.
And so it's very simple nuts and bolts like that. There are all kinds of different metrics. You already named a few. There's the conventional LTV CAC is used generally for subscription type businesses where it's things tend to be more recurring in nature. Metrics that, and these are all shorthand heuristics, so to speak, because if you dig a level deeper, obviously the numbers don't always tell the full story, but things like retention, super important, right? So how sticky are your customers? And you can break that down into customer retention. You can break that down into, well, the inverse of that is churn. You can break that down to revenue retention, because different types of models, whether it's subscription or usage based, or transactional, will have different types of retention metrics. And then you have LTV, right? So LTV can be measured by, is your view that this customer sticks for 2 years, 3 years, 5 years? And during that time, how do they grow with you, and what is the associated economic value that comes with that? But that's really it. I mean, at the core of it, that's really it. The fourth piece, I think, and this one is maybe a little bit less, it's more qualitative than quantitative, is, and I think this is where you're maybe hinting at, is how are you monetizing, right? So the example, I'll use Robinhood as an example. They monetize primarily through PFOF, which is pay for order flow. That's a certain type of revenue. Other competing businesses will say, hey, I'm charging my customer subscription, or others yet will say, hey, I'll charge you commission fees. Like, do you think one is more sustainable than the other? Maybe in some cases there are more risks associated with it. In some cases there might be more associated customer emotions with it, right? I don't like getting charged fees. What does that mean to my customers? So those are more qualitative push and pulls, but that's certainly also does factor in the quality of growth or quality of revenues, in the sense that it does have implications on the sustainability of that stream.
Mm-hmm. That makes sense, David. And in board meetings that you have today, and are there any topics that you see coming up for discussion that perhaps didn't come up 1 or 2 quarters back? What is like your primary advice to companies in that? I mean, your portfolio companies are all in that post product market fit stage for the most part, but obviously we all still have to adapt to what may come. Would love to hear your advice to your companies in these times.
Yeah. So the number one question really is, I think a lot of companies are now starting to do scenario planning, right? So, hey, if the economy goes to various different shades of red,
Yeah.
are we well positioned to survive?
Yeah.
And then the next question from there is, are we well positioned to thrive? Are we well positioned to emerge even better, right? So depending on where you are in the stage of the discussion or that preparedness, if you will, it typically marches through that sequence.
Yeah.
The second one is, I think you hit it on the head. There is a almost a double review, if you will, on like, hey, let's talk about the quality of growth again, right? We've always centered around that, but what's changing this time? Are we, if we were very sure before, let's make doubly sure this time, right? Like, is the quality of growth super solid? Because it allows you then, especially in an environment where there's a lot of exogenous stress, to be super confident about your path without
Yeah.
having to be distracted about, hey, like, is this actually working, right?
Yeah.
Or is it going to come back to bite me out later on? And then the third is basically team, right? And so a lot of it is performance management. Hey, of all the people I've hired, of all the people I'm about to hire, all the plans that I have for whether it's up and down the stack, whether it's people in the engineering team, people on the C-suite sort of management team, um, what do we expect from them, right? Let's narrow the focus to make sure we know exactly what we're trying to play for. And then also in times like this, there are opportunities, right? Because a lot of companies are, and this is just sort of a trend, are letting go, especially later stage public companies are right sizing their teams. And so there's a lot of opportunities out there to maybe say, hey, an environment where it was tougher to hire before, maybe there might be some diamonds in the rough out there, or opportunities that come by. And so just keeping an eye out on that. Um, is I think, depending on which stage of growth you are, I think it can be fairly attractive to some companies. And so just not losing the ball in talent, if you will.
Yeah, that was super interesting, David. So you said three things. The first was scenario planning for different. I like that you used the word different shades of red. There was no orange in there. There was no green. It was different shades of red. So scenario planning for when do you get to survive, thrive, and or come out stronger. And the second was on tracking quality of growth very carefully, and the third was on teams, right? Like, is this the right size team for where we are headed? And you're absolutely right that I'm pretty sure in the bull run of 2021, most companies probably hired too fast, or I mean, and when you're in that hyper growth stage, sometimes there's almost by definition there are always inefficiencies that build up. You just don't have the time to do that audit of whether this team is really contributing the way you'd like that team to contribute, and it's a good time to pause, reflect, and make the changes that are needed. The get fit, right? Like
It's get fit and lean, and that's exactly right. That's it's the three buckets that you just described are right. If you could summarize that in a few words, that's what it is.
yeah, that's great. Cool, David. And more generally, for company, like if you think of a company's journey as sort of there is that 0 to 1, let's find product market fit stage, and then there is sort of you have that early traction. You've hired your early team. You're in that let's call it 1 to 10 million in revenues type run, right? And then there is the 10 million plus maybe scaling stage that many post unicorn companies are likely at. In your mind, what is different in the way companies need to operate, like in that post unicorn stage? Any shifts in thinking, shifts in operating that you've observed that the best companies do, and any pitfalls to avoid?
Yeah. Yeah, no, it's a great question. I love also, Jonathan, I love how you're very clear about the centering metrics in your mind with revenues, which kind of reflects scale. A lot of times what we hear out there is, hey, it's what does a company do when it's $5 billion of equity value, is $10 billion? That's a valuation number, right? A pricing number, which doesn't, there are billion-dollar startups that are later stage of maturity than the $10 billion company, right? Like that actually happens. And so that's exactly how we think of it much more as, hey, how many employees, what's the revenue scale, what is the right that generally signals how mature a company is, obviously with product being the number one sort of KPI, but I think you get the point. So I kind of think of the life cycle of a company in a few qualitative stages, if this kind of makes sense to lay out. And the reason why is we have, again, multiple companies in our portfolio, but some of them fall in different companies fall in different stages. The first one obviously is the pre-product market fit, which we don't do. Post-product market fit, then it's about, we talked about this, growing and naturally, hyper growth. And then, look, every product and business matures at some point, right? And so that hyper growth phase is, we don't think about it almost like it's a little bit too linear to think about it. It's like, hey, this is when you go from Series B to Series E. It's a lot more, and I'll give you examples. Amazon today, you could argue, is still unlocking different S curves, small ones and big ones along the way, right? So like, so many years down the, like, I can't remember when they were founded, 3 decades ago. There's still arguably some parts of the business are in hypergrowth and some are not. And so the point is, every product and business does mature. When that happens, sometimes in parallel with the core business or core product or business that's in hypergrowth, we often talk about this thing called second acts or new S curves, right? Mm-hmm. And so Amazon with AWS is the most prolific example. That was a massive one. Square with Cash App, right? They started with the core merchant business, and then all of a sudden, boom, they have a consumer business. Like, where'd that come from? Mm-hmm. Right. And so that's sort of like, you think of that in totality. The company is still innovating, unlocking new curves. That's still in hypergrowth, if you will. And then finally, when all the growth spurts and S curves, after all that slows down and dies down, then the company matures, right? And at this point, when companies reach its full potential, if it's a great company, it'll be growing slower, mm-hmm. but at a very healthy compounding rate, right? And it will be producing or prioritizing profit margins. Mm-hmm. Hopefully, if the economics work and stuff. And so that's sort of how we see the growth phase, the big, amorphous, where I say, hey, like giving the Amazon as an example, but also, your Series B company is going through that same growth phase. Growth phase is the most exciting phase in the full life cycle, right, mm-hmm. of a company, because of the explosion of innovation, mm-hmm. And growth. And that is where I spend all my time. That TCV, that is our specialty, and we've been doing that for 3 decades. Yeah. The advice that we typically give to our founders, they're underpinned by a few pillars that we actually were talking about before, right? So quality of growth is number one. That's actually, believe it or not, is something that we center around, and we've been centering around forever. Team is, sort of super important, right? Like 10 out of 10 times, the path from a promising startup. So sometimes that's like, hey, unicorn that's poised to disrupt this and that, and it has all that promise. That path from there to like achieving greatness as a company, 10 out of 10 times, what we've seen is it depends on whether or not a CEO founder can surround him or herself with what we like to call a world-class team, right? So a star VP of sales is very different from a CRO, right? Mm-hmm. The biggest difference is not actually the title. The biggest difference is the leadership. Yeah. A great CRO, as an example, is not just good at selling. It's also good at selling, but what they're really good at is their ability to scale the team. So it's not just an effort of one star soldier, but like the impact of an army. Yes, it's a skill. It's a skill. And so the growth phase as a CEO founder, you start spending a disproportionate amount of your energy on team quality. Yeah, right? That's like, hey, I was wearing multiple hats and all that stuff earlier on, but that kind of has to go, right? At some point, as you mature, it's recognizing that the team and the bench that you build around you is super, super important. Yeah. And then also I think what a lot of people don't realize is actually working on your ability to attract that talent to your mission. Yeah. Right. That is paramount. And that's like a skill in and of itself as well. So even if you recognize it, doesn't mean you can do it. Right. Yeah. And then the third one is really, again, back to the topic of, when you're in this phase, if you will, this growth phase, it's keeping your eye on new S curves, right? And so what I'm going to describe is a little bit, there are conflicting statements in there, but you'll appreciate why it's kind of interesting. it ties back to I think some of the stuff we discussed earlier on S curves and examples. It's a very tough balance because on one hand, as a CEO founder, 200% of your focus needs to be on the core product and mission, right?
Yeah.
That's like if you drop the ball on that, game over, right?
Yeah.
But if you're doing it right, oftentimes with the organic evolution, these new opportunities and perspectives will start to emerge,
Yeah.
right? And they can be big S curves that mark inflection points. They can be big S curves that can be needle moving. And so, how do you focus on scaling your core product and business to its full potential
Yeah.
while not being distracted by new shiny objects? And this, by the way, this happens a lot, right? Like, hey, there's a new shiny object comes along, but yet like keeping a watchful eye on what can be truly, truly needle moving for the firm.
Yeah.
Right? 10-year views, 5-year views, and it's much more of an art than a science. It's definitely not one size fits all. It's very different for every company, for every category.
Yeah.
So many things are path dependent, but oftentimes what it does come down to is this delicate balance between visionary and execution, right? And the very, very best CEOs have this unique mix of both qualities of visionary and execution, uh, right, are able to orchestrate a team around them
Mhm.
to achieve both at the same time, right? So
Mhm.
if you're really good at one, gosh, how do you make sure that the other is being done, whether or not it's you're the one that's driving it, or you have a great team that's driving it?
Yeah. Yeah. That was super interesting, David. It's definitely somewhat paradoxical and something that I think about a lot as well. Like, how do you work on maximizing the fullest potential of the current business and not skip a beat while looking for that next S curve? Like where's the next? I mean, and I'm reminded of Apple in a sense, like in the early days. I mean, the iPod to iPhone uh, transition, and it's tough, right? Like, I mean, even after the iPhone, I mean, you can argue the iPad and Apple Watch were kind of good, but not as good as the thing that came before. And it's a balancing act to um, sort of keep optimizing the current machine to its fullest hilt, go faster and faster and faster, while continuously running a background process for what's the next step function shift, what's that going to come from, and keep innovating. And I think you're right that the great founders, CEOs, like tend to balance both.
It's the hardest thing to do.
Yes, it's the hardest thing to do. I mean, we like to look back and see, okay, was Steve Ballmer more one type than the other, and so on. And it's kind of unfair to some of them depending on the time at which they enter the company. But we kind of we know it when we see it in some of the leaders that we have, right? Like it,
Totally.
the story that gets told. I mean, who knows if it's true or not? But the story that gets told is Steve Ballmer sort of maximized the Office and Windows sort of businesses to the hilt and did a great job maximizing that to the hilt, but perhaps missed search, social, mobile, maybe cloud. And who knows if that's true or not? But that's the narrative, unfortunately, that gets told.
That's absolutely right. I mean, like, there we can go on and on about this, and maybe we should. Yeah, this could be a separate podcast on its own. But a lot of similar parallels with Apple,
Yeah,
PayPal, right? Like companies where, gosh, they've done so much right, but if you really think about it,
yeah,
right, as an armchair quarterback, a lot of S curves that you left on the table.
correct. It's almost like the pioneers of shift one missed shift two. And again, very simplistic sort of overgeneralization, but the story that gets told is, Microsoft maybe was fixated on the OS and they missed search. Maybe Google was focused on search and maybe missed social, and maybe social, the folks who are focused on social, maybe they missed mobile in a big way. But who knows if it's true or not? But that's a very simplistic narrative that can be told.
Yep.
That's super interesting, David, and there was a lot of useful insights in there. To change topics a little bit, so you touched upon a little bit on what the great CEOs do well, right? In terms of how they operate, how they think at this stage, whether it means thinking in terms of building an army versus trying to be a super soldier, right? Like you can and making sure you're building the right teams, the right systems that set you up for scale. What are the most common pitfalls that you see companies make in that post product market fit scaling stage?
Yeah, it's slightly paradoxical because it's not, and you might appreciate it once I describe it, but yeah, I think the number one the number one I wouldn't say a pitfall, but danger is losing sight of product and your customers. And so, what you got you here in the first place won't get you to right the next stage. And that's been the theme that we've been uh focused on this entire podcast. But at the same time, there are certain primitives that you can never let go, right? There are some truisms and some things that like these are your core primitives. If you you drop the ball on it, then it's not good. And so one of them is your product, right? So for at least for most of the companies that we invest in, the vast majority of them, they're product driven companies, right? A lot of times they are the market leader, not just because of market positioning and so on and so forth. Those tend to be outcomes of having the best product in the market. It's better, it's faster, it's cheaper. And a lot of times there are technological underpinnings, right? That's the secret sauce. Losing sight of those things, and by that, I mean the culture and the ingredients for product innovation and velocity, right? Those things generally tend to portend success, and a lot of times that people start saying, hey, a classic example, my product is flying off the shelf. I never really, it's a great thing. I never had to focus on building a sales team. Now I'm going to amass, a killer sales force with a CRO of XYZ background. And we're going to go out there and make sure we're, really, really getting our stuff out there through the channels. Then you forget about your product, right? Like the core product itself needs to keep innovating. And so, what are the things that you can put in place, and that piece, that stuff needs to grow as well, right? So we're talking about teams, product teams, we're talking about leadership, we're talking about the right balance of brains execution behind that machinery, if you will, to make sure that it continues to grow. And a lot of times that's in lockstep with how are your companies, how are your end customers evolving with the market and evolving with how you have many times your company, your product has, catalyzed behavioral change, right? And so customers are never satisfied. They will grow. Their expectations only go up. And so are you able to keep up with that pace of delivering, a magical user experience? And that is the key, right? If you focus too much on the other stuff, you can get the best sales team in the world, the best efficiency metrics in the world. But if you forget about making your product that much better than anyone else and everyone else, if the innovation slows down, over time it will catch up with you.
Yeah, that's great. That's great advice, David. Like the invariant of focusing on product innovation, product velocity, and your customers, right? Some things never change. Like, and yet you're right about that. Sometimes when you get large, like you're looking at a lot of spreadsheets, a lot of dashboards, a lot of metrics, and there's a risk that you maybe lose touch with the product and the roadmap and your customers, right? Like it's something I think about a lot. And one of the things I love doing is I send emails to all our customers who sign up, who are like in that first 2 weeks of the product, and I just have a conversation with them on how their first how their experience with Turing has been. And I find I'm blown away by how detailed their responses are. Like people send me like these really long emails on what they would like to see in the product. And I've never like written an email to a CEO of a company saying, hey, can you build this? Can you build that? Can you build this? But it's amazing how responsive customers are if you just ask, right? Like we take this as a crucial source of input when we think about what we put in our product roadmap, what do we build next? And some of our customers say, I'd love to hop on a Zoom and share more thoughts in more detail. And I'm blown away. And these are other C-suite type folks who are or directors of engineering, heads of engineering who wanted to hire engineers who signed up. So
No, that's exactly right. That's exactly right. I mean, you brought to life exactly the spirit of what I'm saying, right? So a lot of companies, the really good ones, I'm sure you guys do this too, is you track this, it's typically it's NPS or CSAT. Those are the two scores, numerical scores that you track in cohorts. And essentially it's like, hey, I just want to make sure I am on top of how my customers are feeling.
yeah,
If there's any drop in satisfaction, any trends, that's a warning sign. So you just gotta make sure they're super happy. But at the same time, that's on the current product, right? So it's all the hard part is really getting to the minds of their minds and understanding their experience, how it's evolving, and
yeah,
how there might be pockets of underserved needs that are emerging or already exist that you can go solve. Because if you don't solve that today, or you don't produce that surplus of value,
yeah,
that becomes a lost opportunity. And if that grows over time, customers will want more, right? That's just
yeah,
how the journey is.
yeah. That's right. And David, like, I have one final question, and then I'm gonna ask Kat from our chief of staff team to ask a question too.
Yeah.
My final question is, in this post product market fit scaling phase, like execution is really important. Having a good cadence is really important in terms of executing on a tight beat. I kind of like this phrase. I think Amazon had it for their Blue Origin thing. I think it was gradatum ferociter, like step by step ferociously is the step. And I think about that a lot in terms of how we execute. And there's somebody who shared this with me, like a founder or someone who said his goal was to build a company that was operationally fearsome, right? That just doesn't. And board meetings, of course, are a good way to like make sure like the company execution sort of marches to a very sort of a tight beat. How do you like to run board meetings? Like what is the TCV POV on board meetings for companies in that crucial post product market fit scaling stage? Like what topics do you tend to discuss? Like how do you run those for maximum impact?
Yeah, no, I love that. It's funny because we don't. Although I do love the quotes, and I wrote them down. The ferocious stuff and the fearsome stuff. That's all great. We don't actually use those words much in the boardroom. What we like to focus on is, um, I think just having a hand on the pulse on how you're tracking execution, right? So execution is oftentimes an output of strategy as well as focus. And obviously it will be subjective to kind of who does it and how that shakes out. What can and generally does happen is you're not going to succeed at everything you do, right? And so the first thing we always try to, as whether we're board members, investors, or even just friends, the first thing I try to always advise people is when you're about to start something, also try to think about what success will look like, right? And this is, by the way, every endeavor we do at TCV is the same thing. Every project, every SWAT team, everything that we endeavor to do, it's always, hey, if we were to do this, what would success look like? And go from there, right? And typically the kind of way we illustrate these are, keep it as simple as possible, right? Don't go super overcomplicated. Don't be overly ambitious in terms of like, hey, because knowing that a lot of times when you're trying something new, you don't really know where the outcome will be, but in broad strokes, what does success look like? And then having the discipline to reflect on that all the time. And so I have launched a product for 6 months, or even 3 months. The easy way to the cop out answer would be, oh gosh, things seem to be going well. Let's give it another year. The really, really good executors will say, we have enough data points now from the 6 months, or we don't have enough data points. Let's go find data points from it. Let's be very critical to ourselves as to why we think it succeeded and not, and how does that map to the original North Star whether it's you measure that KPIs or broad stroke qualitative outcomes. And is it a stop, do more, or something in between? And having that very, very disciplined but also frequent feedback loop is critical.
Yeah.
Because that informs execution that is being dynamically tuned,
Yeah.
and not just in general. Two things can happen, right? People tend to go from that to hope,
Yeah.
or there's a thesis drift, if you will, right? It's okay. What you start out with completely goes off the tracks, but the human mind evolves around with it, and like all of a sudden you've just lost focus completely.
Yeah. Yeah. That's great advice, David. I mean, for us, we think the same way. Like the first question we ask for any product, any initiative we do is, what does success look like? And sometimes you have a way to estimate it, sometimes you don't. And then we track how we're doing relative to that. And then we adjust our plans. And you're right, sometimes things work, sometimes things don't. But it's good to always have that guiding benchmark baseline that we know we are striving towards. So we know if we succeeded or failed in the experiment. And
yeah,
it's great. Thank you, David. And I'm going to invite Kat. And Kat, like our chief of staff team is filled with folks who I think are going to start other companies in the future. And I think and Kat, I'm sure would have some interesting questions.
Yeah. Hey, Kat.
Hey, Jonathan. Hey, David. So you've touched on inflection points in the past. And you've mentioned it a bit here in terms of S curves. Could you share more about how you think about inflection points for companies in the scaling phase?
Yeah. So if you think of, certainly I do, if you think of a company as a living and breathing creature, that's kind of how I like to describe companies a lot of times, then the metaphor for inflection points will probably be sort of these key crossroads in a person's life, which precede sort of big change and opportunities, right? So for example, physical growth spurt, a new job, right? The rare sort of once in a lifetime moments, moving countries or moving cities, like those big moments. That's sort of the metaphor for inflection points for a company. I'll give you two examples to bring this to life. The first one, and I love to use these examples because they're companies that were obviously in our portfolio, and we partnered with them for a while now. They're near and dear to our heart. Netflix. If you trace the history of Netflix, which we've invested in since 1999, and are still obviously one of the largest shareholders. Netflix was originally a DVD mail to home business. I think literally don't even remember the last time I saw a DVD. But that's actually how it started. In 2007, Netflix began quietly investing in the streaming service business, right? And at the time, people were like, streaming. And then in 2011, they announced this plan to actually split its mail and streaming services into two companies. And they required customers to pay for two subscriptions if they wanted to have both DVDs and streaming, with the hope, obviously, that people move to streaming. And that was a strategic decision, which was super sound. I mean, looking back, obvious, right? It would have also allowed Netflix to basically invest more heavily in content needed to drive its subscription business. And that's, I think, that was sort of the thinking. Customers weren't happy. Churn increased. People were like, what is this? And then the stock plummeted. And so, you kind of think about that, right? Like, that's an interesting inflection point in the company's life where you went from a very fundamentally different, it's still at the core of it, it's still high quality entertainment products, but it was delivered in a very different form factor. Massive inflection point. And at that time, we were actually, interestingly enough, it was super fortuitous because the market didn't see that way. The stock plummeted 70%. We thought, at least at TCV, we thought, hey, streaming is going to be this form factor, or it has a potential form factor inflection that would fundamentally alter consumer behavior. That's very obvious today. It wasn't obvious then. And that potential was huge, right? And the rest of the market down to Netflix, that was our chance to invest $200 million of fresh capital back into Netflix's vision to double down streaming. We had obviously made our first investment before 2000. And so that was sort of our chance to double down the big way. And so that's example of one inflection. I go back to Nubank, which we talked about before. When Nubank, they started off with the first core product was a credit card product. And then, their key second product was actually this product called Nukanta, which was a banking account. And so things like savings and checking. And at that time when we invested in it, this product had just launched. And a lot of people at that time was looking at Nukanta and they're like, oh yeah, it's early. We don't know what to think about it. We thought when we looked at it, we say, hey, spent a lot of time working on it. So I spent a lot of time understanding the product. And we thought, gosh, this is a super significant development, actually. Even though it's not being monetized today, we thought that it was sort of this potential to be the center of gravity of workflow. That's kind of what we call it from a consumer lens. It sounds a little bit sophisticated, but it was we believe basically that this thing would be able to unlock a multi-product distribution within the app and really strengthen the mode of the business. And so what that mapped to is a lot of people looked at that and they're like, hey, I don't really understand what this product is. They couldn't value it. We looked at it and said, this is an inflection point for the company. It's going to go to multi-product because of this, or it has that potential. And people thought at the time, shit, $10 billion would have been insane. That was the price that we paid for it, but that's because we valued, I understood this inflection point and we paid up for that, if that makes sense. So those are sort of two examples on inflection points, but hopefully it kind of brings to life inflection points in practice, if you will.
Yeah, those are both really interesting examples. Similar perhaps to case studies, one more question I have is, do you have any books or podcasts or blog posts that you'd recommend to CEOs thinking about growth in their startup?
Yeah, too many. I will say some of these are obviously victims of recency bias. So I'll list out a few. Frank Sluman at Snowflake had published this book. I want to say it was earlier this year or last year, called Amp It Up. I think it's a really good book. It's not just on growth, but it's also leadership. There is an audio podcast called Invest Like the Best, which is, I think a lot of people follow it now, at least it's well followed within my echo chambers. Our founder, Jay, was on it sometime last year, as well as a lot of my favorite founders are on it too, and they've done episodes. And so that one's really good in my view. There are blogs too, which I read. So Stratechery is a pretty good one. That's by Ben Thompson. And there are select founders out there who write really interesting stuff in my view. So Pedro Franceschi, as an example, he is the co-founder of Brex, and he has a Medium blog and he writes things about the company and products, obviously, but also things like, hey, my journey with mental health, and even very deep thoughts on how people scale, right? And so as a company goes through, not just a company but also humans when they're going through phases and whatnot, like let's think about scaling, let's think about growth and patterns that you can draw from both things, and kind of in some ways thematic to this discussion we've had. And so I enjoy his stuff quite a lot. And yeah, there's probably a list of like 50 others, and I can share that with you over email, but those are probably the ones that stick to or come to mind because of recency bias.
That sounds great.
Thank you.
Thank you, Kat. Thank you, David. This was great, and we'll add those links in our show notes. David, this was this was super fun, and I enjoyed the conversation, and I think it would be hopefully helpful for a lot of people building companies at this stage. Thank you for taking the time. And for everyone listening, you can Google for Turing Distinguished Leader Series to look this up. Thank you.
Yeah, thank you. That was super fun. Thanks, guys.